Should I buy Twitter? In this particular video, I'll be doing a stock analysis on Twitter. I'll be going over the company's overview, the key highlights, streams of income, risk factors, competitive advantage, financials, and last but not least, I'll be giving you my personal insight. Of course, I'll let you know whether I think it is a buy. But before we get started, make sure you smash the like button because it helps the YouTube algorithm, it helps YouTube know that there's quality content, and help my videos reach a broader audience. Also, if you're a big fan of finance and investing, and you like finance and investing t-shirts like this, investing, it's in my DNA, make sure you check out my store, Wall Street Stock Apparel, where I make custom finance and investing t-shirts. So this is the Twitter platform, and just to give you an overview, Twitter is a social media platform that lets you send messages in the form of a tweet. By the way, maybe I should tweet, should I buy Twitter? For the video purpose, let me do that. Should I buy Twitter? Gotta put the hashtags, right? I think that's how this thing works. Sweet. So Twitter, I just want to give you some brief information about it. So right now they have 187 monetized active daily users. I'll go into that and the importance of that. Mainly people that use Twitter, 70% users are men, age group 25 to 34. This is actually pretty interesting. It's the #1 social network in Japan. 83% of the world's leaders use Twitter. Interesting. And I just wanted to mention the total amount of Twitter accounts is 1.3 billion. If you want to skip along to different parts, make sure you just check the timestamps below so you can skip around to your liking. Okay, so let's go over the streams of income from Twitter. 86% comes from advertising services, and 13% comes from data licensing, where you can get special access to certain information. But let's dig a little deeper. So for under advertising service, Twitter can make money by promoting your account, promoting trends, promoting tweets. And for data licensing, it's relatively a small amount. Twitter sells subscriptions to public data to companies in developing seeking to search and evaluate real-time historical data. And as you can see, they generated from 2019, it was about $3 billion. And as far as data licensing, it was $465 million. And if you would like to see the annual revenue of Twitter from 2010 to 2020, this chart, I thought it was interesting, and some of these links I'll provide it below so you can kind of visually see it. For advertising services, you've seen that increase nicely. Remember, these numbers are in millions, so if you would turn it to billions, it would be $320 billion. So anyway, this is just a way how you can see how their revenue has been increasing nicely for advertising services as well as data licensing. So for Twitter, you really want to pay attention to the monetized daily active users because that's where they generate the money from. So all these are in millions. So as you can see, the monthly daily active users has been increasing nicely as well. So remember, keep an eye on the monthly daily active users because that's going to be a heavy correlation to their revenue. Now for the competitive edge, I would probably say when you're talking about news real time, a lot of people check Twitter. So real time news, people make tweets. A lot of influential people uses Twitter. So that's what I would kind of say for the competitive advantage of Twitter per se. Honestly, me personally, I'm really not that big of a fan of Twitter. I don't really use it that much, but I'm trying not to make this video too biased. Now for their risk factors, tip ranks where they end up going over some of the risk factors, but a lot of times you can just get the risk factors. I would say to get the risk factors from the 10K. Some of the risk factors that I jot down: steep competitions. Once again, you got Google, Pinterest, Snapchat, and by the way, I did a lot of videos on these particular companies, so you can just check the suggested videos. Also, any rules and regulations regarding privacy, fake accounts. We've seen that 206 million fake accounts, so people are not going to want to advertise when they got a platform with a whole bunch of fake accounts. Innovation, will they be able to innovate just as good as other companies as well? Also, potential security threats. But let's jump into Simply Wall Street, where we can go in depth and look at these numbers pretty closely. So as we can see, we're looking at Twitter. As of the recording of this video, it's $59.66. Let's look at the overall trend. As you can see from here, from 2014 to 2020, it seems all over the place. This is not something I would like to see, folks. A lot of times I would like to see the stock price consistently going up, but with Twitter, it's all over the place. So this, for me, from my personal style, I don't really like to see stuff like this. Also, when I talked about Twitter competitors, they end up comparing a little different ones. Yandex, Pinterest, that's a Chinese company, and Snapchat. And I like how they end up showing the different market caps as well. Oh, and by the way, the market cap for Twitter is $47 billion. So Twitter, 53% 1-year returns, but the industry is 67. Normally, I like to see the company's returns beating the average, now unless they're more mature, and it's at least it's beating the market's 32.9. And then you can also see the breakdown of how well Twitter has been doing to the industry. As we can see, over the 5 years it has been, over the 3 years it haven't, and over the last year it hasn't. So if I was kind of looking at it from an analytical perspective, you can say that as time is going on, Twitter is having a harder time beating the industry. And that's some of the things that you have to assess it. Some of that stuff just comes with looking at stuff over time, and that's the personal insight. It's the little details that you have to pay attention to. So let's look at the earnings. I like how they really broke this down. So they got the revenue, $4.45 billion, cost of revenue, $1.59 billion, gross profit, $2.9 billion, expenses, and then you have the earnings. So from evaluation perspective, this is from a value. If you're a value investing, you're really paying attention to this. But according to Simply Wall Street, the discounted cash flow, which is one way you can value a company based off of the projected cash flows. Normally, you do this for companies that's predictable, and the information that you enter in this is very sensitive. So you want to keep that in mind. But according to Simply Wall Street, based off of their future projections and future cash flow, they're saying that Twitter is undervalued. So if you were buying the stock, that would be a good indication. Like I said, I just pay attention to this roughly. So don't take this for word just because it's undervalued, that this is a great buy. Sometimes you want to understand why it's undervalued and also look at other options. Now we're looking for future growth. This is very interesting. So on Simply Wall Street, for the forecasted annual earnings growth for 1 to 3 years, they project 35.6%. That is really nice. And also, if you look at this one, it mentioned that Twitter's revenue is 18.4, which is lower than what they would like to see in growth stocks, which is 20. But that's pretty much 20 in my case. As you can see, look at the revenue growing over time. It's going from 2.86 billion, and if we can look at it far out from 2023, projected 7.5 billion. So we see a nice thing there. As you can see, for earnings, we've seen a huge drop after the pandemic. Very interesting to see. Maybe a lot of people stopped using Twitter. Want to look a little bit more into that to see what happened there. Once again, you can look at the quarterly reports and they'll end up touching that. See the free cash flow. We've seen it declined around this particular year, but it's supposed to pick up. So that's something right there. It's really interesting. But if we're looking at it from a longer forward looking, we see that the free cash flow, which means more money coming in than coming out, is good, steady as well. So that's pretty good. Now, like I said, for the analysts, the industry is only supposed to grow 17.4, but Pinterest is supposed to be growing 35.6% for the forecast annual earning growth. And as far as the forecast annual revenue growth, they got 18.4. Now, it's good to mention that these are projections and forecasts, so they can vary. But the good thing about it is I like to check other sites as well. We have Seeking Alpha, whose revenue growth says it's 21%. And let's go to Yahoo. So when we look at Yahoo, they're 23. So roughly, we can say that at least for the forecast annual revenue growth, that 18.420 is a fair assessment to make because we've seen multiple different ones. Now, if we're looking at the past historical earnings growth, it's 5.9% over the past 5 years, which you gotta remember, we're more so forward looking for growth stocks. And I also like to see this. So they show a chart of the earnings and revenue history. So it actually goes back so you can actually see how the cash flow was behaving over a longer period of time. They must have just added this feature. That's also nice to see. From the past 5 years, they were able to grow their earnings by 15% in the past year, 29. You always want to compare this to the company and the market as well. Now let's check out the financial health. Now, briefly looking at this, the financial health seems like it's in really good standard. Simply Wall Street may just say that generically because they probably have some type of debt. Boom, debt on equity is pretty high. So they kind of just normally end up saying that about, they don't only generally come up with general stuff, but as you can see, the balance sheet is pretty solid. Assets cover short-term and long-term liability. As we can see, equity is higher than debt. That's normally what I like to see. Debt is increasing, but debt is not always a bad thing. And let's look at the cash. Boom! I love it. The cash covers the debt altogether, so I wouldn't worry about that. Got a lot of cash there. I'm curious to see what they're planning on doing with that cash. So anything relating to debt, I'm not worried about. Look how much cash they have. 6 years of management experience, which is good. Seen a good amount of selling. So if I was a trader or something, I don't necessarily pay attention to this too much. But if I see a lot of sellings by insiders or people in the company, that's normally not a good sign. Okay, so institutions own 80%. So if institutions was not to like the stock anymore, we can see a huge swing. General public 17%. So that's a fairly decent amount as well. And also, I like to use this as well. It's called Lazy Financial Analyst, so that you can give you another way you can end up seeing. As you can see how the revenue end up growing. These are in billions. We can see the cost of revenue increasing as the revenue increase. That's pretty normal. Gross profit is increasing as well. That's nice to see. Also, EBIT. I normally like to look at EBIT because sometimes before net income, research and development, all that stuff are deducted. Now, it's really interesting to say. Remember, I said you have to pay attention to the details. As you can see, for this particular year, the net income was really down. But if you look at, and they actually lost money. But if you look at EBIT, we've seen that they didn't actually lose money. So those are the little details that you want to say. So just because the net income is a loss, you want to also keep in mind of EBIT and EBITDA. The operating income as well, we've seen it has been up as well. We've seen that it was down for a little while and it's starting to go up. But generally speaking, the net income, you would like to see that go up gradually over time. Okay, and I also like to look at this. I believe I got this from the investor relations. As you can see, monetized daily active users has been increasing nicely. You can look at the quarter-over-quarter growth. I would like to see the year-over-year growth. So we're going from 9 to 21 to 27. That's interesting. And sometimes I like to also compare it to what some of the other competitors are. So this is a site called TIPR Terminal, which allows you to kind of compare key metrics. Normally, some key metrics, price to sales, but enterprise value over EBITDA. If you were, it may be a little bit more fancy term, or like for people that's more into finance, but those are the numbers you kind of want to pay attention to for growth stock. Just keep in mind for now, the lower the better. So Twitter is about 28. The mean is 31. So Twitter is about 28, the mean's 31, median is 21. So I just kind of like to keep on those numbers as well. And I also want to show you this site. I like how they do it for different particular sectors. But like for this one, you got Alibaba, you have Amazon. They have a much lower EBIT to EBITDA number, as well as the P over E ratio. They are more mature companies, but those are the one that's more attractive to me. But this one, on the other hand, remember I was talking about gross profit, but this is profit margin. So their profit margin is relatively small, 8%, versus operating margin is 12%. we would like to see those numbers increase. Now, gross profit margin is really low in my opinion. And as you can see, I'll also like to look at, because a lot of times with these social media platforms, the more people on the platform, the better. As we can see, Twitter, they're coming in. Like, look at this. Look as far as competitor users. Twitter's all the way at the 0.33. So that's kind of really low compared to Facebook. So you can argue, yeah, a little bit more from the bigger ones. But when I'm investing in companies, I'm looking for strong companies. I don't want to invest in a company that's fourth or fifth. You also got to remember these bigger companies have a lot more capital. So they can end up having probably better resources, technology, and buying more companies. So if you have a smaller companies, it's going to be hard for you to compete, in my opinion. And so for me, Twitter, if you're a big fan and you think Twitter can grow, the price relative to the price right now, it doesn't seem that bad. If you were probably going to buy it though, $50 price point seems better in my opinion. But I'm really not that big of a fan of Twitter. Once again, there's other companies like the Google, Microsoft, Facebook, Amazon, even Pinterest, even though you're going to be paying a little bit more, I like better. But like, if you think Twitter is a great company relative to the valuation, it's not relatively that bad. It is undervalued. Now, in my personal opinion, I would like to go with the big boys, Facebook, Google, and especially when I'm looking at the metrics that you can use to assess the company. Amazon, Facebook, Microsoft, all of them have better metrics, more established and more predictable companies. So for me, Twitter is too all over the place. I personally don't use Twitter. Honestly, if I had to bet a social media that's end up going to fall off, I would pretty much say it's Twitter or Snapchat. But that's my personal opinion. It's my overall opinion of Twitter. Let me know in the comments below, what do you think about Twitter? If you haven't already, make sure you hit the like button and if you're new, subscribe to my channel.